Gold has dominated headlines for years. Central bankers hoard it, billionaires worship it, institutions treat it as the ultimate insurance policy against economic collapse. But here's what nobody is telling you. While everyone obsesses over gold shattering all-time highs, a far more explosive opportunity has been hiding in plain sight. Silver, the metal dismissed by Wall Street, ignored by mainstream media, and misunderstood by retail investors, is coiling for a move that could reshape global markets. What we are witnessing right now has not occurred since the Hunt brothers nearly broke the financial system in 1980. Back then, it was about cornering the market and betting against inflation. Today, the forces at play are far more dangerous. We are talking about fundamental physics, irreversible geological decline, a technological revolution demanding more of this metal than the Earth can provide, and a geopolitical chess match where superpowers are quietly stockpiling resources for the energy wars of tomorrow. Fresh reports from MarketWatch reveal something unusual. Trading silver has become significantly more expensive. Liquidity is evaporating from futures markets. Margin requirements are climbing at an alarming rate. Yet despite these obstacles, or perhaps because of them, top analysts are charting a trajectory toward $90, with serious projections extending to triple digits. Picture a world where the raw material inside your smartphone, your Tesla, and the solar array on your neighbor's roof suddenly costs 300% more than it did last year. That scenario is not science fiction. Reuters is already modeling breakout prices hitting $90 by early 2026. Think about what that means. The metal humanity depends on for the entire green energy transition. The conductor that makes electric vehicles function, the reflective surface that captures sunlight in photovoltaic cells, the component embedded in every piece of advanced electronics, suddenly becomes unaffordable for manufacturers operating on thin margins. This is the industrial titans crisis unfolding in real time, and the window to position yourself ahead of it is shrinking rapidly. Here is what you need to understand about the current market dysfunction. When MarketWatch describes silver as expensive to trade, they are not referring to the spot price. They are describing the structural cost of maintaining a position in the futures arena. On exchanges like COMEX, traders deploy leverage, putting down a fraction of the contract value to control substantial quantities of metal. That fractional deposit is called margin. When prices swing wildly, exchanges hike margin requirements to protect themselves from cascading defaults. The unintended consequence crushes smaller speculators. It forces weak hands to liquidate. Rising interest rates compound this effect. Borrowing money to hold leveraged positions becomes prohibitively expensive. The speculators flee. Paper trading volume collapses. But here's the counterintuitive twist that most analysts miss. This is extraordinarily bullish for physical silver holders. Strip away the derivatives traders, remove the hedge funds playing short-term momentum, eliminate the algorithm-driven noise. Who remains in the market? Industrial consumers, manufacturers who need actual metal delivered to factories, solar panel producers, electronics giants, automakers racing to electrify their fleets. These buyers do not care about margin calls or swap rates. They care about securing physical supply before competitors lock it up. This transition from paper-dominated speculation to physical delivery demand represents the first crack in a pricing system that has suppressed silver for decades. True price discovery is coming, and when it arrives, $30 will look like a distant memory. The mathematics of silver supply paint a picture that should terrify industrial planners and excite strategic investors. For 3 consecutive years, the global market has consumed more silver than miners and recyclers can produce. The 2022 deficit exceeded 240 million ounces. The following year brought another massive shortfall. According to the Silver Institute, these represent the most significant supply gaps in recorded history. Why can't producers simply ramp up output when prices rise? Because silver does not behave like other commodities. Approximately 75% of annual production emerges as a byproduct from operations primarily targeting copper, lead, zinc, and gold. Mining companies chase those base metals. Silver appears as a bonus, not the objective. Even if prices doubled overnight, copper miners would not suddenly excavate twice the volume just to capture incremental silver revenue. Primary silver mines face their own nightmares. Mexico, the planet's largest producer accounting for nearly 25% of global output, is experiencing geological exhaustion. Ore grades are plummeting. Operators must dig deeper and process vastly more rock to extract equivalent metal quantities. Energy expenditures balloon. Labor costs escalate. Meanwhile, the government has adopted an increasingly hostile stance toward foreign mining interests. Executives whisper about elevated royalties, suffocating environmental mandates, and outright nationalization threats. Capital investment has frozen. New project development has stalled. Peru, the second largest producer, offers an even bleaker picture. Political turmoil has destabilized the nation for years. Indigenous communities regularly blockade access roads demanding greater profit participation. When negotiations fail, operations halt entirely. Multiple major mines suspended production during 2023 due to violent protests. This is not temporary disruption. This represents structural decay in the global supply chain. China produces significant quantities but consumes even more domestically. Their solar panel manufacturing sector devours every ounce they extract and demands imports on top of it. Beijing has transformed into a net buyer rather than a supplier to global markets. They recognize what Western analysts overlook. Silver is becoming a strategic national security asset. Australia, Chile, Poland, and Russia contribute meaningful volumes, yet none are expanding capacity. The easy deposits were exhausted long ago. Remaining reserves demand enormous capital investment, decade-long permitting battles, and tolerance for operating in jurisdictions where rules change unpredictably. The exploration pipeline for new discoveries has run dry. Geologists are not finding significant new deposits because the planet has largely been mapped. Now examine the demand curve accelerating in the opposite direction. Silver conducts electricity better than any element. It reflects light more efficiently than any metal. Modern civilization cannot function without it. Solar energy has become the largest industrial consumer and the fastest growing demand segment. The technology evolution is crucial to understand. Legacy PERC cells are being replaced by advanced TOPCon and HJT architectures. These next-generation panels deliver superior efficiency, but require 20 to 50% more silver per unit. Analysts project the solar sector alone will consume up to 1/4 of total annual silver production within several years. Every government mandate pushing toward net zero emissions simultaneously mandates increased silver consumption. Electric vehicles compound the pressure. A conventional gasoline automobile contains roughly half an ounce of silver in various electrical components. Battery electric vehicles require nearly 2 full ounces, quadruple the quantity. Every Tesla rolling off the assembly line, every BYD exported from Shenzhen, every Volkswagen ID series delivered to European customers accelerates silver drawdown. Fifth-generation wireless networks require silver, artificial intelligence data centers require silver, advanced medical equipment requires silver, military satellites and precision munitions require silver. The modern world runs on this metal, and the modern world is demanding exponentially more of it precisely when geological supply is hitting a wall. Consider the historical price context. Silver touched nearly $50 twice, once during the Hunt Brothers mania in 1980, again during the quantitative easing surge in 2011. Both times it retreated dramatically. Technical analysts identify $50 as a generational resistance level, but inflation adjustment reveals a different story entirely. $50 in 1980 translates to approximately $170 in today's purchasing power. $50 in 2011 equals roughly 70 current dollars. From this perspective, silver at $100 is not uncharted territory. It simply represents a return to historical norms when measured in real terms. The gold-silver ratio provides additional confirmation. This metric tracks how many silver ounces exchange for 1 gold ounce. Currently, the ratio hovers between 80 and 90 to 1. Historical averages cluster around 40 to 1. Monetary tradition dating back millennia established ratios near 15 to 1. Silver is profoundly undervalued relative to its sister metal. If gold merely maintains current levels around $2,400 while the ratio reverts to 40, silver immediately jumps to $60. Should gold climb toward 3,000, a target many central banks appear positioned for, and silver catches up to a 30 to 1 relationship, triple-digit pricing materializes. This catch-up trade historically delivers explosive returns because silver moves with far greater velocity than gold once momentum shifts. 3 distinct phases will characterize the ascent. The grinding accumulation phase is already underway. Prices establish higher lows. Resistance at $30 and $32 gets tested repeatedly. Patient buyers accumulate. Weak hands get shaken out during corrections. The awareness phase arrives when industrial procurement departments panic. Samsung, Apple, and major solar manufacturers suddenly realize physical inventories have dwindled to critical levels. They stop waiting for dips and start stockpiling aggressively. This is survival purchasing, not speculative betting. The mania phase ignites when retail investors notice headlines screaming about silver breaking all-time highs. Gold appears unaffordable at $3,000 per ounce. Bitcoin feels too volatile after another crash. Silver offers tangible ownership at accessible price points. Anyone can buy a tube of coins. The people's trade takes off vertically. Geopolitical dimensions add combustible fuel. Central banks globally are accumulating gold at the fastest pace in decades. China, Russia, India, Poland, Turkey, and Singapore are de-dollarizing reserves and converting paper claims into physical metal. While sovereign institutions focus primarily on gold, the populations of these nations are buying silver. India imported staggering quantities during 2024, tens of millions of ounces flooding through Mumbai in single months. Cultural affinity for precious metals runs deep. When inflation erodes rupee purchasing power, Indian households instinctively convert savings into tangible wealth. Their domestic solar industry is simultaneously exploding, creating parallel industrial demand. China presents the ultimate wildcard. They dominate global solar manufacturing. They control refining capacity. They influence pricing mechanisms throughout the supply chain. Should Beijing classify silver as a strategic resource and restrict exports, a perfectly rational response to escalating tensions over Taiwan, Western markets would lose access to physical supply overnight. The COMEX spot price would become meaningless if metal cannot actually be obtained at that price. Shanghai would establish the real clearing level. Arbitrage between Eastern and Western markets is already widening. Premium pricing in Asia reflects tighter physical availability. The flow of metal is migrating eastward. When Western institutions finally attempt to rebuild inventories, they will discover the East sets the terms. Skeptics raise legitimate concerns. A severe global recession would crush industrial consumption. Factory closures, automotive sales collapse, consumer electronics demand destruction, all would temporarily reduce silver offtake. Deflationary shocks historically punish silver before gold. We witnessed this in 2008 and 2020. However, examine what follows every crash. Central banks unleash monetary stimulus. Interest rates plunge. Liquidity floods the system. Recovery phases deliver spectacular precious metals rallies. The post-crisis rebound of 2020 catapulted silver from $11 to nearly $30 within months. More importantly, today's demand structure differs fundamentally from previous cycles. Green energy mandates are statutory obligations. The Inflation Reduction Act, the European Green Deal, China's carbon neutrality commitments, these are not discretionary spending programs vulnerable to budget cuts. Governments will print money to build solar farms even during recessions. Silver demand has become policy-driven rather than purely consumer-driven. That represents an unprecedented safety net beneath prices. The mechanics of breakout involve specific technical triggers. Sustained closes above $32 flip algorithmic models from selling rallies to buying dips. Momentum accelerates. Commercial short positions held by bullion banks become vulnerable. These institutions maintain enormous short exposure to hedge client flows. Rapid price appreciation generates margin calls. Covering shorts requires buying. That buying propels prices higher. Additional margin calls cascade. The feedback loop intensifies, identical to the mechanism that launched silver toward $50 in 2011. Retail FOMO delivers the final propulsion stage. When financial media broadcasts $50 silver as headline news, millions of investors discover an asset they had previously ignored. Compared to Bitcoin's volatility and gold's inaccessibility, silver appears attractively affordable and surprisingly undervalued. The mass psychology of inflation hedging finds an outlet: industrial shortage, institutional short squeeze, retail mania. Combine these three forces and triple-digit silver becomes mathematically inevitable. Physical market dynamics reveal even deeper stress. Dealers report a phenomenon called unobtainium, periods when spot prices decline on paper markets, yet physical premiums explode. During the 2021 social media-driven squeeze attempt, coin premiums reached 50% above spot. The paper price and physical price told contradictory stories. This divergence signals that futures markets no longer reflect genuine supply and demand. When the definitive squeeze materializes, silver ETFs will face redemption requests they cannot satisfy with metal. Prospectuses contain clauses permitting cash settlement. Investors believing they own silver will receive depreciating dollars. Physical holders will control the only real supply. $100 silver restructures global manufacturing economics. Solar panels become substantially more expensive, potentially slowing the green transition that governments have mandated. Every smartphone, laptop, and data center server carries higher input costs. Electric vehicle production margins compress, medical device pricing rises, defense procurement budgets strain. Companies will desperately seek substitutes. They will fail. No element combines silver's conductivity, reflectivity, and antimicrobial properties. There is no replacement. Industry must pay whatever the market demands. Mining equities would experience a renaissance. Operations with $15 production costs suddenly generate margins rivaling software companies. Stock prices follow earnings explosions. Historically, silver miners outperform bullion by factors of 2 or 3 during major advances. Select companies could deliver 10 to 20 times returns. Physical metal ownership eliminates counterparty risk entirely. You possess it. No custodian can lease it without permission. No exchange can settle your claim in cash. Storage and insurance costs represent the trade-off. In an increasingly unstable financial environment, that trade-off appears increasingly worthwhile. The next 12 to 24 months will prove decisive. Central bank gold accumulation legitimizes hard assets. Geopolitical flashpoints show no signs of cooling. Inflation remains embedded regardless of official statistics. The purchasing power of fiat currency continues eroding. Silver occupies the unique intersection of monetary insurance and industrial necessity. Nothing else offers this dual function. Nothing else remains this undervalued relative to its strategic importance. This is not speculation. This is logical extrapolation of observable trends. Deficits are documented. Demand growth is mandated by law. Supply constraints are geological facts. Generational opportunities arrive infrequently. They require conviction to seize and patience to hold. They reward those who position before headlines confirm the thesis. The silver market remains remarkably small. Total investable supply represents a tiny fraction of global stock and bond markets. Modest capital inflows move prices dramatically. When institutional allocations shift even marginally toward precious metals, the impact will be violent and immediate. A 40-year suppression of real assets relative to financial assets is ending. The pendulum swings back. Positioning ahead of that swing creates extraordinary wealth. Waiting for confirmation guarantees paying premium prices. Headlines will eventually announce what fundamentals already reveal. By then, the opportunity will have passed to those who acted while others hesitated.